ASC 815 provides the definition of a derivative, but it also includes a number of scope exceptions that either allow or require an entity to avoid accounting for an instrument as a derivative. In other words, a contract may meet the definition of a derivative based on all of the derivative criteria, but if the instrument qualifies for a scope exception, you may account for that instrument under other GAAP rather than under ASC 815. ASC 815-10-15-13 provides a list of 15 types of contracts that are not subject to derivative requirements, even if they meet the definition of a derivative. Now, some of these are more intuitive, like a lease contract, residual value guarantees, and certain types of loan commitments. Be careful, though, because even if an instrument doesn't require derivative accounting in its entirety, it still has to be evaluated for embedded derivatives. For example, a lease would never be accounted for as a derivative, but embedded payment terms in the lease could meet all of the criteria for bifurcation based on ASC 815-15, and an entity may still have embedded derivatives to account for. A frequently applied scope exception relates to normal purchases and normal sales, which is potentially applicable when an entity is purchasing something in quantities that will be used or sold by the company in the normal course of their business operations. But there are a number of specific criteria to consider when assessing and documenting the applicability and eligibility for the scope exception. And we also frequently receive questions on the applicability of the scope exception for certain contracts that are not traded on an exchange. Now, this scope exception is commonly applied to payment features tied to revenue or EBITDA measures of one of the parties to the contract, or to research and development funding arrangements, for example. But the scope exception can be challenging to apply, especially when a contract contains more than one underlying, and some, but not all, qualify for a scope exception. Requests from stakeholders for further clarification on this has led in part to one of the FASB's current projects on derivative scope exceptions. In July, the FASB published a proposed ASU which would exclude from the scope of the derivatives guidance certain contracts. And those certain contracts are those with underlyings that are based on the operations or activities specific to one of the parties to a contract. So think about a contract with an underlying that's a business operation or an event, something like obtaining regulatory approval on a drug. The proposal also provides a new framework for evaluating embedded derivatives with multiple underlyings to determine whether scope exceptions apply. Stay tuned for more on how these potential scope exception changes develop as the FASB receives feedback on their proposal.